Hi, this is Michael from Foxy Monkey, and today I have with me Robert Weaver from Property Partner. Thank you, Rob, for inviting me.
Pleasure.
So Rob is the Chief Investment Officer at Property Partner, and I'd like to ask a few questions about Property Partner, about the work that you do here, as I see a lot of interest in Property Partner.
Sure.
First, for those that don't know, Property Partner is a property crowdfunding web platform, and it allows investors to invest in a hassle-free way, let's say, in property. And Foxy Monkey is a personal finance website that focuses on investing, on life hacking, and basically passive income generation. So, with a goal to become financially dependent. So, the goal is to generate enough passive income that will, eventually cover your living costs, and then you are financially free.
Yeah.
So, Rob, why don't you tell us a little bit about what Property Partner is and your role here?
Right. Well, Property Partner essentially is a crowdfunding platform. We invest in property. Originally, it was residential property, and we've migrated into purpose-built student accommodation, PBSA for short. Done a little bit of commercial, and more recently, we've done a second charge loan bonds as well. So lending to the developers, so not the equity piece. We've been going 4 years, so we've got good track record. Started with the very first property in Croydon, and we've built up and the size. So we've moved into buying blocks of flats and blocks of for student accommodation. So yes, we've got longevity, and we've got the portfolio up to in the region of 135 million, roughly, in terms of value, and growing every time we put a property on the platform.
That's great. That's great. I've certainly seen a lot of interest in the platform, and you are the guy who's behind all the acquisitions and important negotiations.
Pretty much, yes.
Right?
Yeah.
So
that's my day job,
okay.
And it's what I've been doing all my career. So that's what sets you apart from doing it on yourself. Doing buy-to-let by yourself is you've got to learn the market. You might not necessarily get to know the deals in that market, and generally, buy-to-let, they invest in their own local area. They can't get exposure to the rest of the UK. Somebody living in London is very difficult to buy in Newcastle or Sheffield, the northern powerhouses.
Mm-hmm.
So we cover the UK, but also again, whether you're an individual, you're buying. You can only really afford to buy 1 or 2 properties. So that's really all your risk is concentrated on those 2 properties. And yes, things can go wrong. What's more, they're also putting a large piece of debt on it as well, borrowing up to 75%. So you're taking high concentrated risk and then amplifying it yet further through the mortgage. So that's quite, in my mind, that's quite scary, and I wouldn't necessarily do it that way. And also, as you remember, you've got to get the interest, rent interest offset is pretty much ending fairly soon, and so now that's going to generate very little income, if at all. And some people have already bought in.
Mm-hmm.
They might find themselves in negative income once that is totally gone. So these are through buying through a corporate structure, we can still do that.
Right.
So basically, you get regional diversification. You can buy a small bit of a property and buy many pieces. That's the attraction. You can buy into properties that you wouldn't be able to buy on your own account. So when we do a £3 million student block,
I wouldn't be able to invest in that alone.
But you can now. You can invest through Empiric, which is a REIT, but you're buying in all their properties. Whereas here you get to choose if you've got a particular flavour. You're not going. Your kids are going to York. You want to invest in the York market, then you can do that. So that's the advantage. And then the final piece, it's known as the holy grail in the property market, is liquidity.
Yeah.
It's very lumpy actually, and it takes quite a while to actually transact property. Through us, we buy shares in the only vehicle, and those shares trade. And we're seeing really circuit moment about 1 million a month trading on the platform, which is very liquid. Yes.
And this was actually one of the main areas, the main advantages that I saw when I started investing in Property Partner, liquidity, because and the secondary market, because when you invest in property, it may take months for you to get your capital growth back. You may get the rent every month, but capital growth can only be realized when the property is sold.
But also it's a risky time because you need to remove the tenant. before you can sell it. So you've got a vacant property, and that takes its time. Then you're at risk of vandalism. And I've seen some dreadful cases where people have gone in, nicked the radiators and hot tanks and haven't turned the water off. Wow. No, I've been doing this man and boy.
Right. So I'm sure there are a lot of advantages, but what I want to focus as well is trust, because trust is very important when investing. I may be investing some money in property partner, but I want to make sure that, first of all, property partner will not close shop and leave and then waste my money. And I want to make sure that my investments will last, so that the company will last as well. So talk to us how property partner ensures that my investment, my money is safe.
Sure. Okay. Well, we're buying property. We're not buying other things. So property, and it's in a very well established legal framework, and all property transactions are recorded at land registry. So way we structure it is because you can only have 4 names on that land registry. So we buy it in a company structure which is on the platform, and it's a special purpose vehicle. And that will be the owning entity of the property. So that will be actually at Land Records. You can actually do a satellite view on Google Maps or a street view and do a virtual. And
see the actual property that you're buying.
And see the actual property you're buying. It's there. It's not a hole in the ground, which I've seen other things. It's a genuine property, and so you can type a genuine property. You can see. Actually, you can drive past it yourself if you're nearby, and Land Registry Records. So that's the entity. Now that is the safety side is separate from property partner. They're not owned in our same entity. We are separate. So if we, on a dreadful day, we would go bust, for example, the property is still there with its ownership and separate ownership structure. And then obviously a practitioner would come in and then look to do what he needs to do at that stage. We have a contingency plan where we put money aside for that to happen, if that we should get to that. So that's a nice sort of safety net. But rest assured, it's owned separately. It's not. We don't have control over it. We can't actually go and do a big borrow and then go and buy a racehorse, for example. It's there, and it's real, tangible assets. That's
and property partner is FCA regulated.
And we are FCA regulated and governed by the Financial Conduct Authority. Yes.
Yeah.
Same with the trading platform. It's called a multi-level trading facility regulated by the FCA again, and it's literally just one downgrade from a fully listed exchange like the London Stock Exchange.
Okay. I didn't know that.
Oh yeah, places huge regulatory compliance on us. We have to do daily reporting trades. It's really to monitor sort of shorting and spread betting on websites, which we don't have on ours, but we have to be able to deal with that. Reporting.
That's interesting to say. Yeah, because trust is really important to me, especially if I want to put some serious money. Okay, maybe if I put 100 to 100 pounds, that's okay. But if I want to put some serious money, a big chunk of my net worth into property, I want to make sure that if I don't go via the buy-to-let traditional route, then that my money is safe.
Absolutely. I categorize it. I get nervous when I'm buying a lampshade on the internet. Will the lampshade turn up? You never know with the internet.
Which is why I'm doing this interview. Actually.
Exactly. And this is a different grade of money. This is your long-term investment money. It's the high value money to you. So it's got to be the safest deployment, and that's why we treat it as such, because that's why you can actually look at the property. You know what you're investing in, and it's legally allocated to that entity.
Okay.
You can't get much better than that, and it's there.
Okay. No, that definitely covers me, and I'm glad that you guys are also very transparent about it. So every time that when you didn't know about me, having a blog and having a presence, I had to ask questions. There are a lot of people that actually helped me, such as Kyle, Faraj, to basically understand more about it. And I even actually came and visited you just to make sure that this company is real.
Yeah, we do have an open door policy as well, so you can actually come and visit us any time. That's one of the things we did from the get-go, because it's nice to be reassured. There's an office. There's real people there.
No, but I Yeah!
The reason I wanted to interview Rob as well is that he's an expert in buying and selling properties. Why don't you tell us a little bit about that?
I've given up a long career to come and work here and do this thing. I was really attracted to the liquidity and the diversification piece that this new company was offering, and that got me out of the Royal Bank of Scotland. I've been in sort of big institutional jobs all my career, and I'm now doing this.
Yeah.
Yes, well, I got at my day job, so I'm a specialist in buying my type of property. I don't do commercial, for example. I've done residential investment and I do student accommodation. Those markets I know, and I've got contacts in them. And I'm actually buying properties that a buy-to-let investor cannot buy, which will be the entire block. And the advantage of buying the entire block is that I control the freehold, so I control the service charge. We don't have a ground rent to pay. So it's actually, and I'm buying at a discount as well, because we've got the wholesale retail issue and other issues are built into that. So I'm buying at a discount from what, instead of buying one flat, say at 200,000, I'm buying 10 of them, but 180,000 each. So it's a better deal all round. And as I say, yes, we know, we have the contacts in the market, we know what we're looking for, we know how to negotiate. This is our job.
Right. Because myself as a software engineer, I'm not an expert in property, and obviously, I've read a lot because out of interest. But I'm not as good as a professional would be.
Yeah.
So I think it's important to let the professionals do the work as well. But at the end of the day, as an investor, you have to take it's your final call.
It is, yes, exactly, but not quite, because although I might choose that property, ultimately we put it on the platform,
and you don't have to invest.
And you don't have to invest.
Yeah.
Investors to say, I like Rob's judgment or I don't. That's
it reminds me of active versus passive funds that we have in the stock world.
Yes.
And usually people say, oh yeah, you should always invest in active funds, so that there's an active management, active decisions behind them, because let the professionals do the work. But actually it all comes down, yeah, sure, I want to let the professionals do the work, but it comes down to fees as well. And the reason I'm investing with Property Partner is that, unlike active management, it has a very good fee structure for property. So if I remember right, if I'm not a premium investor who has some benefits, like 0 or 1% fees to invest, I'm investing with a 2% fee in the beginning, which means that if I hold the property for 5 years, it's a one-off fee. So if I invest for 5 years, that comes out to 0.4% a year, which is something that I'm willing to accept for all the work that you do.
Yeah, no. And the other point I was going to add is that once I've negotiated a deal, that's the deal that gives my platform. We don't take a slice of that. So take Golden Hill Fort, that was a cracking deal. That goes on at the price we negotiated. That's a contract price, and that's what goes on the platform. It's no sort of
there's no
creaming off
lots of asterisks and terms and conditions. Right. I wanted to talk to you also about the portfolio building and building long-term wealth in Property Partner, because I know you have two sides. One is the equity side, where you purchase properties and you rent them out, and the other part is the development loans, which is I lend my money. And you, in partnership with a third party, you go and lend the money to a developer, and then the developer pays you back, and you pay back the investors.
Yes, yeah. But they're two very different pieces. Where the equity you're owning the property with leverage, and so if there are value movements, you benefit from the up and the down of the value movement. Whereas with debt, it's a loan. So you just get a coupon, a rate of interest, and so if the value moves up and down, you don't benefit from that. So in a way, in a rising market, you're not going to get the gains, but in a defensive market, you're not going to have the losses, unless it's a wipeout, and then it's a total loss.
Yeah,
which
is a risk, obviously, that you have to take.
It's the Armageddon scenario. It is the risk, and so and there's the risk chain in that. The first charge, the lower risk, a smaller proportion. Then you have the sort of the mezzanine second charge, and at the very top, the equity piece, which carries the highest level of risk. That's the first loss, as we call it. So it's that. So, and I think one of your things you were asking whether it's better or worse. You can't see it as that. It's actually you're getting a higher return for your risk. Now, is the level of return commensurate for the level of risk? That's the question. It's no better or worse than the first charge, because you're getting higher return, they're getting lower rate, but they're safer.
Yeah,
So
I guess the question is your risk adjusted return better?
Yes.
Which is the $1 million question, I guess,
Yeah,
right?
that's the million.
So this is what we have to do as investors, and assess the opportunities and say, yeah, this looks like a good deal. I've done my due diligence. I've read the papers, and I see that you disclose a lot about properties before asking investors for funds.
Take for example one on the mezzanine loans, second charge loans. We've done them through an innovative finance ISA, so you can actually put your ISA in it. And so take one of those that was delivering 11% return over, I can't remember, it's 12 months or 15 months. But net in the tin, 11% tax-free, because it's an ISA. So therefore, if you're a 50%, for example, 50% tax rate, I'd have to be earning 20-odd%.
Yeah.
So
to make the net.
So the question I ask myself: where can I generate 20% in a non-really risky environment to actually get that level return? I can't. So that's that. So in a way, that's my answer is yes. I'm happy. I was happy to invest in that.
Yeah, ISA is a tricky one actually, because by investing in ISA, you only have 20K to invest every year.
Yes.
So by investing in ISA, you're actually sacrificing your there's an opportunity cost, let's say, right?
Yeah.
That you're not investing in something else in order to invest in this. So it has to be a good deal for you to get into.
Yes, and exactly. And if it's like that, if it's in that double digit, 10-11% return, then yes, you've got to weigh that up.
True. Yeah. Shall we talk about the elephant in the room, Brexit? Because I know a lot of people are worried. A lot of people, are scared to invest. I have actually some people from outside the UK that contact me on Foxy Monkey and say, I want to invest in property, but because I know you allow European investors to invest as well, and contact me and say, actually, you know what? I'll wait and see how the Brexit thing plays out, and then I will invest. What's your view on that? What's the impact so far and in the future of Brexit?
Yes, right. Well,
it's a big question.
There are two areas. I say the two markets I know best: residential investment and student accommodation, and they're very different at the moment. Residential market has slowed right down, and so as a consequence, capital growth has slowed. And it's a very difficult call to actually know where the market's going to go. Suffice to say that we are still an island. We have got a shortage of property, and the population is growing. So there's always going to be a demand fundamentals. But there are periods where uncertainty, and Brexit is causing one of them. So we are seeing slowdown in growth, and so I suspect we have seen less interest in residential accommodation. Residential investment, whereas phenomenal interest in our loan bonds, because that's an interest, and it's not, you're taking away all the exposure to the residential market. So
it's different assets.
So it's the same asset class, different purpose. That's a loan, and you'll get the interest, and you'll no exposure to the capital movement of it. So you've de-risked any price drop by doing that, but you're going to miss out on the price rise. So, but conversely, student accommodation, that's an institutional market where institutions are still looking for long-term dated money, long-term income. So what we've seen is it's been a very resilient asset class. It's gone through the global financial crisis with very little drop. It's had some really big curveballs thrown at it. Tuition fees, massive, should have a massive impact. No impact on value going through the long-term records. So it's a very resilient defensive asset class, and it's delivering a strong, what looks like a strong income. Again, if you look at the risk adjusted compared to commercial, where it's 3.5-4%, and students can be 5 to 6. There's a reason for that, because of the covenant strength of BP, who's going to pay you on that office building, regardless whether they're there or not, is very different to 50 students leaving in the summer and leaving at 50 students. But it's a strong market, it's a strong yield. So you're investing in university, so it is delivering good, acceptable levels of income, and so that's in demand. And then we've seen this very strong interest in institutions and a lot of consolidation. So that's actually also added to yield compression, so value add. So Brexit has had, I think, very little impact on that particular market.
Okay. The way I see student accommodation is from the tax perspective, it's very lucrative to myself and other people that invest through a limited company, because I know that property partner pays the rent as dividends.
Yes.
Which means that if you invest as a company, the dividends are exempt because of double taxation.
Right.
And I've written a long piece. It's boring, but I know tax is
You know more
important.
than I do.
It's boring, but tax is very important.
Absolutely.
Because what matters is your after-tax returns, and if you can find a nice way of doing that, like through a limited company, then it's a win-win.
Yeah.
Yeah, and to continue on the Brexit and London side, do you think that obviously London is not growing as fast as the rest of the UK now, and London is is a market of its own, right? Where do you see London in the next 5 years? And do you think, I know some properties on Property Partner are trading at like 15% discount near my house actually. So
well, yes.
What's up?
We actually did. We've stayed away from prime central London, so we've only gone on the perimeters, and we acquired with a capital growth theme in mind, which is Crossrail, a major infrastructure adding value. So we acquired those in sort of early 2015 through that year. We haven't bought any since then. So they've had the benefit of quite a lot of capital growth, but that's eased off. I think house price indices are showing 4%, maybe even less. So a number of those we've actually sold and returned the cash because we think that maybe not going to go that higher. And where they've had a discount, we're thinking, right, well, let's prove the value and return the cash to investors. So that's we've done that. We've done that in 3 examples already. But where we are in prime London, the sort of central London, but the overseas people know, Chelsea, Mayfair, Battersea. It's a very difficult one. It's a market I don't know personally very well. It's very high end, big money, international money.
the very prime London.
Very prime London. It's a very niche sector.
Okay. So you try to stay away from the very niche prime London because
absolutely.
There's high risk as well, I guess.
Absolutely. We've always been sort of the middle market, main market. So if the market's declining, people from the higher end will come through, and if the market's growing, people from the bottom end will come up through. So it's the middle transition point.
Okay.
So that's where we try to be. But I've always been amazed by how resilient London's been over my career. And I couldn't understand why values have been growing so much until somebody at a conference and said to me, "Oh, it's the capital city of the world." And when you look at it in that perspective, it's you take away just the local market. It's where international money will invest.
Yeah.
And who knows?
I think a lot of people just invest in London because they know that it's a market that they will not lose.
Absolutely.
So it's not only
very
about
defensive.
wealth, growth. It's about preserving your wealth. And when very rich people invest in London, that's what they care about. And they care about investing somewhere that they know their money is safe and earning some interest that they're not losing.
Yeah, no, the very, very prime is really to preserve the super rich, or as the Candy brothers call it, the uber rich.
Yeah.
And they're kind of insulated from recession because they're so cash positive. So yes, those areas have maintained their value. But yes, I think we just have to get through Brexit and.
One way or another.
One way or the other. To be honest, it's not knowing is the most damaging bit.
Yes, the uncertainty.
A bad decision would be better than no decision.
Yeah, I agree. Yeah, and speaking of assets and pricing, I think investing is a funny one. That they say that there are not good or bad stocks. Every stock is good at the right price.
Yeah, absolutely.
So it's the same thing with London. I think if I I may look like a fool if I'm saying that I'm buying London right now, but what if I'm buying London at 20-30% discount?
Absolutely.
And then 5 years down the line it plays out well. So I think it's finding the right price for the asset and not just buying Manchester because it's Manchester right now.
Yeah, no, I agree. We one of the things we had on our platform, we had a property in Eastbourne and a property in I can't remember, it was in Newcastle or Manchester. One was showing a high yield, and I was talking to an investor and said, "Oh, it's definitely that one then." I said, "Well, no, not necessarily, because that's in a really core location in the central business district in Manchester. So it should be a low yield. And what we're doing is we're offering different levels of discount for the property. So we've adjusted that out. So when you get the different yields, that's they're on a par. They're
Yeah,
both as
yeah.
equally as good, but delivering different for the level of risk.
Yeah, definitely. You mentioned the REITs
Yes.
earlier on, and I'd like you to talk to me about REITs and how they compare to property partner, because I invest in property partner, but I also invest in stocks.
Yeah.
I buy funds, and REITs are real estate investment trusts that invest usually commercially or
Correct,
some
yes, yeah.
mainly commercially. And how do they compare to property partner? Why would I buy an investment planning property partner and not a REIT?
Well, that's the issue. There aren't that many. There's not many REITs to start off with. There are more commercial ones like British Land, who specialise in offices. You've got regional capital, more industrial. They moved into shopping centres. On the residential side, there are a couple of specialist ones which are quite small, and on the student side, I couldn't tell you. Unite's a big traded company, but I can't tell you what's a REIT. But there is another one called Empiric. They're a REIT. Now the difference is, yes, they're totally tax transparent, so the money that comes in comes out without having taxation. But you're buying into a fund. You're buying into the fund manager's expertise, and you're buying into that. So they had a property, and it's a big conglomerate. The difference in property partner, we don't have the tax benefits, but you get to choose which property you want to invest in. There's also PAIFs, the Property Authorised Investment Fund, which is the property version of a unit trust.
Okay.
Again, also tax transparent. The REIT's closed-ended, and the PAIF is open-ended.
Okay.
So yeah, and there's one called Hearthstone. Again, similar. I think it's similar size to ours, but that's the only I know of. The only traded PAIF there is. So the choice is not really there.
Okay.
If you want to go to this sector, commercial, no problem at all.
I see. Okay. What is speaking of investment plan? This is a way for an individual to invest in property partner without having to pick individual properties, right?
Absolutely.
So
yes.
it's like I give you the money. I think the minimum is £5,000 or £1,000 recently. Yeah, it's I give you my money and then you make the investment selection for me, but you invest in the same way that other people invest. There's not a bigger bonus. It's just you're buying into the expertise of someone in property partner.
Yes and no, in that it's not an individual that goes and selects the stocks for you and here we go. It's an algorithm that's written.
It's written by you?
No, not by me. No,
by property partner.
By property partner. Yes, it's an algorithm written on a certain number of facts, right? Like biggest discount to trading, or biggest discount to value, income, and so on.
Growth,
and you can choose between the various sectors, and then that will deploy the lump quickly. It's like investing made more simple, as opposed to just going through. And we've got quite a few SPVs now, about 120, I think it is, to go through and select. So that's quite a tall order. There's a lot of choice there, which makes it slightly harder. But yes, that's all it is really. It's an easier, quicker way of deploying a larger lump.
Saves time and may provide better results as well.
Yes,
I want to compare myself with. I was actually thinking of splitting my investment chunk in two: one in investment plans and one in my own selection, and compete with myself.
I'm a property person, so I'd always go for if I'm picking properties, I'll pick it myself. But yes, it's easy with whatever your preference is.
Okay. One very important question that I wanted to ask is, when you're investing in stocks, bonds, funds, we have this theory, the efficient market hypothesis, that says that basically every little bit of information is incorporated in the price of the asset. So if I'm buying, the Tesla stock at $180 a share, that means that all the public information is priced in. So I'm not gaining much and I'm not losing if I'm buying this individual stock. And I was wondering how this compares with property. So if I'm buying a property at I don't know, at a price of 300K, let's say, is there some value that I can extract as an individual person, or is it the market is so efficient?
The market is efficient. It's not totally efficient because it's not a transparent market. It's not a totally liquid market. That hypothesis works with liquid markets, so stock exchange and readily tradable shares,
Okay.
large volumes traded. Property is very different. It's lumpy and it could take 6 months to transact. It doesn't have that same day, so it doesn't have that. And also there are other things going on. And one of the big attractions for residential property, for example, is the nature of it. It's made up by owner occupiers who don't behave in the same way as commercial institutions. So when you get value falls, they won't suddenly sell, right, I'm getting out of this sector, I'm going to move out of my house and live in a bond. You just don't do that.
Yeah.
It's your home. It's your home for life. And even if you are selling, you go and buy another home.
Yeah,
So
yeah.
it's trading within that. So other stops are, for example, if values go by a long way, like in the global financial crisis, up to 20% in the residential market. But a lot of people, some people might be caught in the negative equity trap. They are not sellers. They will not sell it, and
They just keep on living in their own home. Yeah.
and recover. So what happens is the supply reduces massively. So the supply demand dynamics go out of kilter, and it sort of puts a check on the price on the market. So to give an example, the residential market declined by 20% peak to trough. Commercial was nearly 50%.
Wow, which is more represented in the stock market.
Yes, because
I guess.
the market's going down. Investors, I, as a fund manager, I need to act on behalf of my investors and sell and get out. Or close open-ended funds had to sell their assets because there was a big demand on big run on redemptions. Liquidity. So that's what happens. But commercial does come back up again. It's very volatile. That's why residential has been one of the least volatile markets of all the asset classes, and well, good performer over the long term.
If I've seen something in London, it's also what's called sticky selling,
yes.
where the price doesn't really go down, but no one sells, there is not enough properties in the market, and the price doesn't drop because no one wants to sell.
Exactly.
So the price is called sticky.
Yeah. But this is where my job comes in, just to spot the opportunity. A negotiated discount. That is what I call proper pricing. So, for example, on our platform, there's an interesting property called the Golden Hill Fort. It was a Grade 1 listed monument. Also, it's a fantastic fort on the Isle of Wight.
Oh wow, seen this.
Yes. So it was in the hands of receivers, sadly, and so we were looking at. They don't have much knowledge of the property because they haven't developed it. The developers done that, and they've had to take control. So they sell it as seen. So there are no warranties or anything like that with it. And so we basically bought it for 2.7 million, and the value on the island valued at 5 million. So a very, very big discount. Now,
very big discount.
Yes, but that was the right price to pay. Bear in mind the level of risk we were taking on, because there was uncertainty on the listed planning. There'd been earth collapse on the earth. There's been circular earthworks on the outside. That's only minor. Isle of Wight is riddled with subsidence. I know that sort of Victorian people building forts, for example, would overspec it as soon as there's some either siege.
Yeah.
Anything that
you want to live in a castle.
And they kind of they know where to put it away from the areas of subsidence. So when you have that inherent knowledge, you know that really fundamentally it's okay. And basically, we were able to eradicate all these risks on the planning, the subsidence. I had a surveyor walk around the perimeter on the night before we exchanged. I spoke to a specialist insurer to make sure we weren't in an area of subsidence, we weren't. And so I eradicated all those risks. And those building regs needed signing off on 5 of them. Managed to track down the contractor before we bought it. So we eradicated all those risks. So we were buying at a big discount. Because we removed the compensation for risk that had all gone.
Mm-hmm.
So it's spotting those. It's actually that knowledge of knowing that property is sound, but I will get a very good price on it.
Yeah, and investors actually took it very, very well.
Oh, they did.
Because I saw it. I think it was usually when I go to property finder, I like to sort by discount and get the best value out of the properties that are trading at a discount. And I think this one was the last one. So it means that it has the highest premium on the platform out of hundreds of properties.
Yeah. And another one again it's interesting. We have an op fund, opportunity fund,
okay,
where specifically so it's in cash, and so if I can find an opportunity that needs a cash purchase to move quickly, I can do it. So we saw a student block for sale at auction.
Mm-hmm.
That's odd in its own right. That's the wrong place for it. Failed to sell on the day. I wasn't surprised by that. So we were able to pick up the phone, and you have to sign an auction contract, cash deposit straight away, because of fall of the hammers in exchange of contracts. So we were able to transact. We were going to do it a week. It actually took us 2 weeks, but we were able to move on that one and get a great price. It's valued up already, and I think once we've established it, stabilised it, it will have a bigger value, much bigger value from what we bought.
Yeah, the opportunity.
So it's actually spotting those things. They don't come every day of the week.
Yeah.
But they'll come.
In hindsight, I think I would have definitely bought in the fort, but I didn't.
Well, it's a risky one because
it is. And actually, a friend says that I'm the most boring investor because I only like boxes.
Yeah.
Like I like flats, but I like boxes. There's no, they're not edgy, and they're usually city center. It's like the most boring investment. But I quite like that because I'm that type of investor.
Well,
I only do boxes.
And as a partner, it's a solid investment because it's really built. It's solidly built. It's got granite works out, granite stairs. The most indestructible stone you can come across.
Wow.
So no, I love that one.
Nice. Well, Rob, thank you very much for spending the time with me today, and I'm sure people will find it valuable. And I wish you best of luck to you and Property Partner. And I'll be staying in touch and update people with my own portfolio as well if anyone cares.
Share the performance. Yeah.
Yeah.
Yes. Good.
Right. Thank you.